Crypto sentiment is picking up after the deep fear, after the leverage crash, but is still only in sort of the neutral band of the spectrum. And maybe that shouldn't really be a surprise. October 10th effed a lot of people up, man. It wiped out accounts completely, zeroed people. Other asset classes have been surging. Stocks are just making a laughing stock of crypto here with the gains they've been putting in. And the 4-year cycle is making people very nervous. It could feel like it's already over. The top was 126, down only from here. The fear's creeping in, man. The dread is here. But the idea that we've already topped just doesn't really hold up when you look across the market. Compared to previous peaks, there's no wave of retail money coming in. Meme coin mania came at the wrong time, too early to mark a top. There's really not much froth like we saw with NFTs back in 2020. And that was stupid, man. People were paying $1 million for a picture of a monkey. Bitcoin has moved, of course, but the altcoins lagged big time. We only ever had mini alt seasons and specific niches. In most past cycles, on the other hand, tops are loud. They're real loud, man. Everyone's screaming from the rooftops. Crazy numbers. It's gonna go up forever. Everyone's getting hilariously rich. Hasn't really happened this time. We haven't had any delusional characteristics. In fact, those have been completely lacking so far this cycle. Plus, we really need to consider the macro situation. And what's critical right now is that tightening from the Fed is winding down. That means if we take a look at what's happening at the Fed right now, QT appears to be in its final phase. Now, JP Morgan thinks it gets cut this week. You might even have found out by the time we publish this video. But it's coming, okay? Jerome Powell said it himself. And because QT now is in its final phase, this is good. It means the Fed's gonna end their balance sheet runoff, is gonna take a lot of pressure off the markets. Also, we have rate cuts incoming, almost certainly starting from this weekend. By the time we publish this, you may already see that. This means softer financial conditions and exactly the kind of environment in which risk starts to improve. While at the same time, it looks like the dollar and the real economy are both turning. The DXY is down from the highs of earlier this year. And if it continues to trend lower, we get added tailwinds to dollar-denominated assets. This matters because a softer dollar tends to support everything from commodities to stocks to crypto. And at the same time, very importantly, ISM manufacturing right now is just below 50. It has been turning up. It's close to crossing 50. When it crosses 50, that's a level that can mark a return to expansion. And if it starts to move higher in a turning economic cycle, then Bitcoin should show its usual correlation to move higher too. We top with the business cycle, have every cycle before. Okay, it's not this rigid 4-year cycle structure. It's that the business cycle has tended to have these 4-year cycles. It's extended this time. We have not had a top for the business cycle. Now, for sure, if that does happen, this is an extended Bitcoin cycle. It breaks the previous molds. We are in the institutional phase, the ETF phase, the sovereign phase, and really it would be a break from previous trends. It would be different this time if Bitcoin did not follow the business cycle. It's just a question of which trend breaks, the 4-year cycle or the business cycle correlation. My bet's on the 4-year cycle, okay? The macro environment is more important than this rigid halving structure. And the Bitcoin miners are less important than ever with the ETF demand. In fact, maybe it always was, but that's another discussion. Anyway, let's now talk about what Dr. Copper has to say, because this is a very, very important signal. Before we get into that, guys, question for you. Are you finally going to start taking your trading seriously and move over to an exchange that actually is built for traders like you? FEMX is one of the OG cryptocurrency exchanges. I've literally been using them for years at this point. They have deep liquidity. They're available to anyone, anywhere. That's you. It might need a VPN in some cases, okay? These guys are running one of the most aggressive offers in crypto. Make your first deposit of $5,000 or more. You get $1,000 cash back. That's crazy, man. Put in 5K, get $1,000 back. It's that easy. Plus this month, new and existing users, so if you signed up before, you can unlock up to Ethereum in trading bonuses. That's around $4,000. Not bad, right? So question, are you gonna make the switch today to an exchange that's gonna reward you this much? Links right down below. Go check it out. Claim what's yours. Okay, Dr. Copper, look, we all know that gold has been on a crazy run. You've probably heard us talk about it relentlessly. This is largely down to central banks shifting away from US treasuries, shifting more towards gold, with China in particular stockpiling tons of precious metal. We have a bit of retail mania coming in here as well, likely marking the intergalactic top for gold for a while. But also interesting is the copper to gold ratio. We've talked about this on the channel before. It's been a while since we talked about it, but we're talking about it again because if gold is now topped, at least for a little while, then we may see a breakout in favor of copper. And when copper rallies, this is directly associated with improving economic health. That's why it's known as Dr. Copper. Copper is used in all kinds of wiring and all that kind of stuff. Huge industrial use cases. On the charts, copper looks set for a big bounce against gold. And the copper chart looks a lot like gold's chart right before its breakout. Strength here for copper is wildly important and should not be underestimated because it implies the economy moving back toward industrial production and infrastructure build out. From nuclear power plants to residential housing, conditions that tend to favor broader market expansion. And also, if we take a look over at tech stocks, again, the data does not suggest a blow-off top ... yet. Still a while to go. Yeah, stocks are at all-time highs. Yes, there'll be big, fat, disgusting corrections on the way up to wild blow-off tops. But at the same time, if you look at the forward PE ratios for top stocks, they aren't even close to levels at the top of the dot-com bubble. The crazy thing is earnings have largely kept up because of the insane AI boom right now. The Mag 7 are becoming asset-heavy businesses. This market isn't yet precarious. Fundamentals are real, unlike the dot-com boom, so it makes the parallels hard to pull at this point. Later, yes, I think the mania will come, where you'll see AI companies launching for tens of billions of dollars in valuation that have absolutely nothing behind them. But the fundamentals right now are real, and large cap tech still has room to absorb more capital, and the CapEx spending is insane right now. If this were the end of the cycle, we'd expect to see earnings flattening out, margins compressing, guidance fall off, but that has not happened yet. And let's not forget here, today's US stock market is pumped by built-in passive flows from retirement plans and the broader investing infrastructure, with paychecks automatically funneled straight into index funds. While on top of that, US markets have essentially become the de facto global equity market, creating a worldwide hub for capital formation. Companies from all around the world list in America. Also, on the positive side for markets, oil prices are low, and although crude oil pulling back can reflect weakening demand, it can also be interpreted as a disinflationary pressure release. Lower oil prices mean cheaper logistics, less strain on consumers, and supports the idea of a soft landing. If Jerome pulls this off, which it looks like he has, which is the wild thing. Jerome, man, for all the shit he gets, best Fed chair ever. Gonna give him that. Anyway, this is all constructive for both equities and crypto. And on the subject of traditional assets, there's one more economic piece that hasn't really clicked yet. Real estate is the unreleased valve, and the more the Fed cuts interest rates, the more that pressure is going to be released. The US housing market is at a record value of around $55 trillion, but almost none of it is being actively tapped as people aren't selling or refinancing in the current market conditions because interest rates are too damn high and nobody wants to take a freaking mortgage. But the Trump administration has talked directly about easing the housing market. When rates come down, locked up equity starts to become mobile again. And if markets play out anything like 2020 to 2021, when low rates drove a wild frenzy, a huge refinancing boom, people refinancing their house and buying dog coins, any liquidity unlock will show up in the markets, including, yes, in crypto. Jerome Powell's probably going to cut rates at least a few more times. We might see 100 basis points of cuts before he leaves in May. And then Trump's going to put on a puppet who's probably going to cut us down to 1%. And as for how crypto is performing right now, BTC and ETH are holding up relatively well enough to start with some reignited cautious optimism after the big October 10th crash. While most altcoins are still, of course, big time underwater from previous highs, a lot of them, of course, won't come back. Like I've said before, it's probably like 100 investable assets in crypto right now. But if the macro plays out bullishly, then the end of this year and into 2026 should see crypto finally enter the cycle's true expansion phase. We can expect to see BTC and ETH at new highs, big ETF inflows, a resurgence for all those bullshit treasury companies. It'll get crazy, man. Followed, of course, by the Total 3 breaking out, with major altcoin ETFs also in operation. We're getting our first listings this week. This rally actually would then lead to a real blow-off top in crypto, in equities, in everything, the everything top. Excess froth leading to major sell-offs, of course, midterms weighing on sentiment later in 2026. All this stuff could see an unraveling of markets late 2026, maybe early 2027. But until then, the incoming setup favors acceleration and risk-on positioning, which is how I position my portfolio. Let me know how you positioned yours. Thanks for watching.